Today, we will talk about understanding mutual funds. What is a mutual fund? A mutual fund is a financial vehicle that pools assets from shareholders to invest in securities like stocks, bonds, money market instruments, and other assets. Mutual funds are operated by professional money managers who allocate the fund's assets and attempt to produce capital gains or income for the fund's investors. A mutual fund's portfolio is structured and maintained to match the investment objectives stated in its prospectus. Mutual funds give small or individual investors access to professionally managed portfolios of equities, bonds, and other securities. Each shareholder, therefore, participates proportionally in the gains or losses of the fund. Mutual funds invest in a vast number of securities, and performance is usually tracked as the change in the total market cap of the fund, derived by the aggregating performance of the underlying investments. Most mutual funds are part of larger investment companies, such as Fidelity Investments, Vanguard, T. Rowe Price, and Oppenheimer. A mutual fund has a fund manager, sometimes called its investment advisor, who is legally obligated to work in the best interest of mutual fund shareholders. How are mutual funds priced? The value of the mutual fund depends on the performance of the securities in which it invests. When buying a unit or share of a mutual fund, an investor is buying the performance of its portfolio, or more precisely, a part of the portfolio's value. Investing in a share of a mutual fund is different from investing in shares of stock. Unlike stock, mutual fund shares do not give their holders any voting rights. A share of a mutual fund represents investments in many different stocks or other securities. The price of a mutual fund share is referred to as the net asset value, NAV, per share, sometimes expressed as NAVPS. A fund's NAV is derived by dividing the total value of the securities in the portfolio by the total amount of shares outstanding. Outstanding shares are those held by all shareholders, institutional investors, and company officers or insiders. Mutual fund shares can typically be purchased or redeemed at the fund's current NAV, which doesn't fluctuate during market hours, but is settled at the end of each trading day. The price of a mutual fund is also updated when the NAVPS is settled. How are returns calculated for mutual funds? When an investor buys Apple stock, they are buying partial ownership or a share of the company. Similarly, a mutual fund investor is buying partial ownership of the mutual fund and its assets. Types of mutual funds. There are several types of mutual funds available for investment, but most mutual funds fall into one of four main categories, which include stock funds, money market funds, bond funds, and target date funds. 1. Stock funds. As the name implies, this fund invests principally in equity or stocks. Within this group are various subcategories. Some equity funds are named for the size of the companies they invest in: small, mid, or large cap. Others are named by their investment approach: aggressive growth, income-oriented, value, and others. Equity funds are also categorized by whether they invest in domestic U.S. stocks or foreign equities. To understand the universe of equity funds, use a style box, an example of which is below. 2. Bond funds. A mutual fund that generates a minimum return is part of the fixed income category. A fixed income mutual fund focuses on investments that pay a set rate of return, such as government bonds, corporate bonds, or other debt instruments. The fund portfolio generates interest income, which is passed on to the shareholders. Sometimes referred to as bond funds, these funds are often actively managed and seek to buy relatively undervalued bonds in order to sell them at a profit. These mutual funds are likely to pay higher returns than bond funds aren't without risk. For example, a fund specializing in high-yield junk bonds is much riskier than a fund that invests in government securities. 3. Index funds. Index funds invest in stocks that correspond with a major market index, such as the S&P 500 or the Dow Jones Industrial Average, DJI. This strategy requires less research from analysts and advisors, so there are fewer expenses passed on to shareholders, and these funds are often designed with cost-sensitive investors in mind. 4. Balanced funds. Balanced funds invest in a hybrid of asset classes, whether stocks, bonds, money market instruments, or alternative investments. The objective of this fund, known as an asset allocation fund, is to reduce the risk of exposure across asset classes. The portfolio manager is commonly given the freedom to switch the ratio of asset classes as needed to maintain the integrity of the fund's stated strategy. 5. Money market funds. The money market consists of safe, risk-free, short-term debt instruments, mostly government treasury bills. An investor will not earn substantial returns, but the principal is guaranteed. A typical return is a little more than the amount earned in a regular checking or savings account, and a little less than the average certificate of deposit (CD). 6. Income funds. Income funds are named for their purpose, to provide current income on a steady basis. These funds invest primarily in government and high-quality corporate debt, holding these bonds until maturity to provide interest streams. While fund holdings may appreciate, the primary objective of these funds is to provide steady cash flow to investors. As such, the audience for these funds consists of conservative investors and retirees. 7. International and global funds. An international fund or foreign fund invests only in assets located outside an investor's home country. Global funds, however, can invest anywhere around the world. Their volatility often depends on the unique country's economy and political risks. However, these funds can be part of a well-balanced portfolio by increasing diversification, since the returns in foreign countries may be uncorrelated with returns at home. 8. Specialty funds. Sector funds are targeted strategy funds aimed at specific sectors of the economy, such as financial, technology, or healthcare. Sector funds can be extremely volatile, since the stocks in a given sector tend to be highly correlated with each other. Socially responsible funds, or ethical funds, invest only in companies that meet the criteria of certain guidelines or beliefs. For example, some socially responsible funds do not invest in sin industries such as tobacco, alcoholic beverages, weapons, or nuclear power. What do you think of our video? Let me know in the comments section below. Before you go, please hit the like button and subscribe to my channel. Thanks for watching.